CapitaLand Ascott Trust just made a 4 billion Japanese yen move in Japan. While not a mega deal in size, this acquisition reveals a masterclass in strategy that every investor should understand. What does this quiet but calculated purchase of 3 rental apartment buildings tell us about the future of the trust? And what does it mean for your portfolio? Let's break it down. Before we jump in, quick disclaimer. This video is for education and general information only and does not constitute financial advice, investment advice, or a recommendation to buy or sell any security or investment product. The views expressed are based on publicly available information at the time of recording and may change without notice. Always do your own research and consider seeking advice from a licensed financial advisor before making investment decisions. Welcome back to the channel. For those new to the name, CLAS is a Singapore-listed REIT with a global portfolio of serviced residences, hotels, and rental housing. In recent years, management has been actively refining their portfolio to build resilience and deliver stable, long-term returns. A key battleground for this strategy is Japan, which is why this latest acquisition, though modest, is so significant. So let's look at the deal at a glance. CLAS has acquired 3 freehold rental housing properties for 4 billion Japanese yen, or about 34.2 million Singapore dollars. These are young, modern, and strategically located assets. 2 are in Osaka, Splendid Nanba West, a 56-unit building, and Pregio Esca South, a 48-unit property, both completed in 2021. The third, Prix de Clort Nishi Kyogoku, is an 85-unit property in Kyoto from 2020. The choice of Osaka and Kyoto is deliberate, targeting cities with positive population growth from young professionals and students, creating sustained rental demand. Now, how was this deal funded? This is where the strategy shines. CLAS used a combination of proceeds from a prior sale and new Japanese yen-denominated debt. Specifically, they recycled capital from the divestment of an older property, the Citadines Karasuma Gojo Kyoto. The financial metrics tell the most compelling story. The expected net operating income yield on these 3 new properties is 4%. Compare that to the asset they sold, which had an exit yield of just 0.4%. That's a 10-fold increase in yield, a textbook example of smart capital recycling. This brings us to the core strategic rationale. This isn't an isolated purchase. It's a direct execution of their stated strategy. Unlock value from divestments, reinvest in higher-yielding assets, and upgrade the portfolio. But there's a deeper strategic pivot at play here, the deliberate shift towards the living sector. CLAS management has a medium-term target to have 25 to 30% of their portfolio in assets like rental housing and student accommodation. Why? For stability. Think of it this way. Hotels are fantastic growth assets, but their income can be volatile. Rental housing, on the other hand, provides a predictable, resilient income stream. These acquired properties boast an average occupancy of around 97%, with average leases of about 2 years. This creates a solid foundation of stable income that balances the more growth-oriented side of the business. It's a classic barbell strategy designed for consistent performance. So, what is the immediate impact on the trust's portfolio and its earnings? Let's talk numbers. Financially, the acquisition is immediately accretive to distributable income with a projected pro forma DPS uplift of 0.3%. While modest, this positive accretion is significant in context, proving the effectiveness of their capital recycling. When combined with other recent accretive deals, these transactions create a powerful compounding effect on earnings. Looking at the portfolio composition, this deal further cements Japan's importance to CLAS. The trust now owns 33 properties in the country, and Japan's share of CLAS's total portfolio value will rise to 17.7%. More importantly, the allocation to the living sector gets a significant boost, representing about 17% of the total trust value. This is a concrete step towards that medium-term target of 25 to 30%, systematically de-risking the portfolio. And what about the balance sheet?
The decision to use Japanese yen-denominated debt creates a natural hedge against currency risk. Since the rental income is in yen, having the loan in the same currency protects the trust's bottom line. As of mid-2025, CLAS maintained a healthy financial position, underscoring its strength to pursue these strategic moves. Of course, this investment is timed to capitalize on an incredibly favorable market in Japan. The country's hospitality and real estate sectors have powerful tailwinds. Inbound tourism has already surpassed pre-pandemic levels, with an ambitious government target of 60 million foreign visitors annually by 2030. This boom is fueled by pent-up demand and a weak yen, making Japan an attractive and affordable destination. On the real estate side, this demand is pushing up hotel performance, but new supply is constrained by rising construction costs. This bottleneck benefits owners of existing high-quality properties. And while hotels thrive, forecasts predict rental housing will be one of the fastest-growing accommodation classes. CLAS's strategy is perfectly tailored to capture the best of both worlds. Now, no investment is without its risks. Japan faces long-term demographic decline nationally, high property taxes, and natural disaster risk. However, CLAS is mitigating these risks. By acquiring new, freehold properties, they avoid the costs associated with aging buildings and seismic retrofits. By focusing on cities like Osaka with positive population growth, they counter the national demographic narrative. On the financial front, a change in monetary policy is a risk, but the use of Japanese yen-denominated debt provides a strong partial hedge. Operational risks are manageable given the newness and high occupancy of the buildings. So, what is the future outlook for CLAS? This acquisition provides a very clear signal. The trust is laser-focused on building a resilient, all-weather portfolio. We can expect to see more acquisitions in the living sector to reach that 25 to 30% target, further bolstering stable income. The combination of proactive capital recycling, a disciplined strategy, and favorable market tailwinds in Japan positions CLAS exceptionally well to deliver stable, long-term returns. In conclusion, this 4 billion yen acquisition is a strategically profound move by CLAS and a prime example of their disciplined portfolio reconstitution. By swapping a lower-yielding asset for a higher-yielding one, CLAS has immediately improved its earnings quality and fortified its portfolio. This deal is a critical step in their pivot towards the living sector, timed perfectly to leverage Japan's market recovery. What are your thoughts on this acquisition? Let me know in the comments below. And if you found this analysis helpful, please consider liking and subscribing for more. Thanks for watching.